What happens if delivery requests spike? In less than 6 hours, more than $1 trillion in combined precious metals market value disappeared. Silver dropped over 5% intraday. Gold fell nearly 3%. Silver now sits roughly 40% below its January peak near 121. And yet, 30-day implied volatility in silver options is higher today than it was when price was trading at that 121 high. Read that again. The options market is pricing more instability at 74 than it did at 121. That is not normal post-bubble behavior. Large size hit the paper market during peak liquidity hours. The window was open, and someone used it. The move itself is not the real story. The volatility response is. When price falls sharply, the dominant narrative becomes simple. Excess cleared, speculation washed out, trend reversed. Anyone questioning that framing risks being labeled dramatic or irrational, but labels are efficient tools. They reduce inquiry. Modern financial systems operate on perception as much as settlement. Media compresses structural complexity into binary storytelling. Up equals strength, down equals weakness. Markets, however, are not moral judgments. They are clearing systems under stress. If you want clarity, bypass commentary and verify primary sources directly. Pull CME open interest data, updated daily. Check options implied volatility surfaces, publicly available. Read CFTC commitment of traders' position. Review Treasury debt projections from official budget documents. Scan central bank balance sheet releases. None of this requires interpretation, only attention. The informed minority does not argue with headlines. They compare price to structure. And right now, structure is diverging from the headline. Start with volatility. 30-day implied volatility in silver futures options is more than 10 points higher today than it was 3 weeks ago when silver traded at 121. At the high, volatility was elevated but controlled. At 74, volatility is expanding. Options markets price forward movement, not past movement. If implied volatility rises as price falls 40%, traders are not positioning for calm continuation lower. They are positioning for instability. Convexity demand is increasing into weakness. Now examine open interest. March silver open interest remains elevated relative to typical historical rollover patterns. Contracts representing hundreds of millions of ounces remain open with first notice day approaching. Historically, participation begins to thin meaningfully well before delivery deadlines compress. This time, positioning appears comparatively sticky. Pull the data yourself. Updated daily. Publicly available. When open interest stays elevated late in the cycle, it introduces a liquidity question, not a guarantee of disruption. A question. Layer onto that regional physical premiums. In certain Eastern exchanges, physical silver has traded at double-digit percentage premiums relative to Western derivative benchmarks. Same metal, same global supply chain, two price regimes. That is pricing divergence. If physical buyers consistently pay materially above paper benchmarks, it implies either localized shortage or distrust in derivative settlement mechanisms. Paper can move rapidly in 6 hours. Physical cannot. This divergence between volatility expansion, elevated open interest, and regional premium behavior is unusual when compared to prior corrections. Now zoom out. This is not occurring in isolation. Official projections show U.S. federal debt rising by multiple trillions annually over the coming decade under baseline assumptions. Interest expense is projected to become one of the largest line items in the federal budget. Those projections assume no severe recession. Debt trajectories at that scale require constant refinancing. Refinancing requires liquidity. Liquidity depends on confidence. At the same time, multiple major currencies have weakened materially when measured against gold over multi-year horizons. This is often framed as a gold rally. It is equally a currency repricing. Credit markets are also sending signals. Credit default swap exposure in certain large-cap sectors has expanded meaningfully over the past year. That is not panic, it is hedging behavior. When CDS markets expand while equity indices remain elevated, it suggests quiet risk transfer beneath surface stability. Systems rarely break during visible panic. They strain during apparent calm. A macro thinker once described how long periods of stability accumulate hidden fragility. When release occurs, it appears sudden, but the pressure built gradually. Silver volatility expanding at lower price levels fits that template. Fragility is rarely visible in the headline print. Now, consider fundamentals. Silver is not merely a speculative vehicle. It is the most electrically conductive metal on the periodic table. Modern infrastructure runs on electricity. Solar panels require silver paste. Electric vehicle systems incorporate silver in power electronics. AI data centers demand conductive components. Military electronics rely on high-efficiency conductive materials. There is no scalable substitute that matches silver's conductivity profile at current industrial requirements. Industrial demand has remained structurally strong for several consecutive years. Meanwhile, primary silver supply growth has been limited. Mining output is capital-intensive and slow to expand. Above-ground inventories are not infinite. In multiple recent years, total demand has exceeded newly mined supply, creating structural deficits that were bridged through inventory drawdowns. Paper pricing can fall 40% in weeks. Industrial demand does not adjust at that speed. One physical ounce of silver currently costs less than many branded consumer products people purchase without hesitation. That disconnect between industrial utility and derivative pricing is worth examining, not emotionally, structurally. Now add geopolitics. Energy choke points remain sensitive. Roughly 20% of global oil flows through a narrow maritime corridor in the Middle East. Military drills or missile tests in that region, even if pre-announced, signal strategic tension. Energy disruptions feed directly into manufacturing input costs. Manufacturing feeds directly into industrial metal demand. At the same time, trade tensions between major economies remain unresolved. Sanctions frameworks, export controls, and industrial policy shifts alter supply chains gradually. Silver sits at the intersection of energy transition, electronics, and defense infrastructure. When geopolitical friction rises while structural deficits exist, timing matters. Layering pressure on an already tight system does not require crisis headlines to matter. It compounds background stress. Now Steelman the bearish case. A 40% drawdown is real technical damage. Momentum traders exiting can extend downside beyond fundamentals. Historically, only a small percentage of futures open interest results in physical delivery. Most contracts roll or settle financially. Paper markets retain significant capacity to move price independent of physical flows over compressed time frames. Volatility spikes often resolve lower if no catalyst materializes. Geopolitical drills frequently normalize without supply disruption. If economic slowdown accelerates, industrial demand could weaken, reducing physical tightness. Housing affordability stress and tightening credit conditions can force broad asset liquidation, including metals. These are legitimate counterpoints. Liquidity in derivative markets is powerful, and price is the final arbiter in the short term. This is market analysis, not investment advice. Now return to convergence. Several timing layers are stacking within a compressed window. Options expirations in both exchange-traded funds and futures markets. First notice day approaching for major delivery months. Key macroeconomic data releases on inflation and employment, central bank policy communication windows. Each of these individually is routine. Together they concentrate risk transfer. What should be monitored daily? CME open interest as delivery approaches. Does it decline in line with historical patterns or remain elevated into the final days? Implied volatility term structure. Does short-dated volatility compress or continue expanding? Physical premium spreads between regions. Do they narrow or widen? Credit default swap levels in large cap sectors. Are they stabilizing or increasing? Currency performance against gold across multiple jurisdictions. Institutional positioning in the CFTC reports. These are measurable indicators. No narrative required. If implied volatility is higher at 74 than it was at 121, the options market is signaling uncertainty not visible in the headline price. If physical premiums persist while paper corrects sharply, that is pricing divergence. If open interest remains elevated into compressed settlement windows, that is a liquidity question. The majority will look at a 40% drawdown and conclude the cycle is over. The minority will compare volatility, positioning, credit stress, currency behavior, and delivery structure. Two prices can exist temporarily: paper and physical, stability and fragility. The only question that matters is which price regime adjusts to the other over time. Invest with logic, not hype.